Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Financial Leverage Explained: Benefits, Risks, and Real-World Insights. Financial leverage is a tool that can amplify both gains and losses. It's the practice of using borrowed money to increase potential returns. For businesses, it can help fund growth or large projects. For individuals, it might support investments like real estate or stocks. But with the potential for higher rewards comes higher risk. Understanding how it works is key to making smart, informed decisions in both personal and business finance. What is financial leverage? Financial leverage is a cornerstone concept in finance, used by businesses and individuals to maximize potential returns. At its core, it's about using borrowed funds to increase buying power or expand investments. While it can boost profits, it also raises the stakes by increasing losses if things don't go as planned. Understanding this tool is essential for making sound financial decisions. Definition and explanation. Financial leverage refers to the strategic use of debt to finance assets or investments. The goal is to achieve higher returns than what could be earned using only your own money. Think of it as using a lever to lift something heavy. With a smaller input, you can create a larger output. For example, imagine a company takes out a $500,000 loan to purchase equipment that increases productivity and profits. If the added revenue outweighs the cost of the loan, interest and principal payments, the leverage worked as intended. However, if profits fall short, the business could struggle to repay the debt, leading to financial trouble. On a personal level, this concept applies when someone uses a mortgage to buy a home. Instead of paying cash, they borrow most of the money from a bank. If home values go up, the homeowner gains equity far beyond their initial down payment. But if values drop, they're still responsible for repaying the loan, even if the home is worth less than the loan balance. Types of financial leverage. There are different ways financial leverage comes into play, depending on how it's applied. Here are 2 main types: operational leverage. Operational leverage happens when a company relies on fixed costs, like machinery or facilities, to increase production. Fixed costs stay the same regardless of output, so as sales grow, profits increase at a more significant rate. This is the financial equivalent of doubling down. When operations are efficient, rewards can be substantial. However, during downturns, fixed costs still need to be covered, which can create financial strain. Example: a subscription-based software company invests heavily in servers and infrastructure. Once these fixed costs are covered, every new subscriber generates revenue with only marginal added expenses, boosting profitability. Financial leverage. Financial leverage focuses specifically on borrowed money. Companies, or individuals, use loans, bonds, or other debt forms to fund activities that would otherwise be unaffordable. The goal is to earn a return that exceeds the borrowing cost. While this can increase growth potential, it also carries the risk of over-leverage, where obligations outpace earnings. Example: a business issues bonds to raise $2 million for expansion. If the expansion drives sales growth, returns can more than offset the bond payments. But if the market slows, bond repayment obligations will remain, even as revenue declines. By understanding these types, you can better see how financial leverage works in various contexts. It's a double-edged sword. When managed wisely, it can boost growth, but mismanagement often leads to trouble. So, is it always worth the risk? That depends on the situation and how prepared you are to handle potential downsides. How financial leverage works. Financial leverage is at the heart of many strategies used to grow wealth or scale businesses. It works by multiplying the resources you already have with borrowed capital. The idea is simple. By using someone else's money, you can potentially achieve larger gains. But it's not risk-free. Let's break it down. Debt as a tool. Examine how businesses use debt to amplify returns. Debt can act like a turbocharger for businesses. By using loans or bonds, companies can access funds they don't currently have, which helps them grow faster than relying solely on profits. The goal is to ensure that investments financed through debt generate returns higher than the cost of borrowing. Here's how it works. A company borrows money to invest in revenue-generating assets, like machinery, new products, or market expansion. The borrowed money allows the company to increase production or sales far beyond what its cash reserves alone could support. If the growth outpaces loan costs, interest payments, and principal, the company sees greater profits. For example, imagine a company takes out a $1 million loan at a 5% interest rate to automate its factory. If automation boosts profits by $200,000 per year, the leverage works favorably. But if profits drop due to unexpected issues, the business still owes the loan payments, which can strain finances. The takeaway? Debt is a powerful tool, but one that can backfire if revenues fall or costs rise unexpectedly. Equity financing. Discuss how equity can also be leveraged in investing. Leverage isn't limited to just borrowing money, you can also leverage equity. Equity financing occurs when funds are raised by selling ownership stakes, like through stocks or partnerships. This method is popular among both startups and large businesses. How does equity play into leverage? When you're an investor, equity in a company essentially means owning a portion of its profits and risks. Investors use this ownership to participate in potential returns larger than their initial investment. Similarly, businesses use equity contributions from stakeholders to fund growth without taking on high levels of debt. For individual investors, this might look like buying stocks on margin. A brokerage lends you funds to buy more shares than you could afford with just your money. If the stock price rises, the returns on your investment are magnified. However, if prices drop, losses are equally amplified, and you still owe the brokerage money. In business, issuing new stocks or attracting venture capital gives companies room to expand without overloading on debt. However, it dilutes existing ownership stakes, meaning profits are shared across more shareholders. Both debt and equity have their place in financial leverage. Using them wisely depends on the situation, risk tolerance, and the potential for returns exceeding costs. Benefits of financial leverage. Financial leverage offers unique advantages for businesses and individuals aiming to achieve higher returns, save on taxes, or grow rapidly. When used responsibly, leverage can be a game-changing tool to maximize resources and drive success. Below are some of the key benefits of financial leverage. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.